First and foremost, I want to say thank you for stopping by our YouTube channel, Breaking Stereos. Today, our goal is to educate you on how to buy and sell options, diminishing that financial gap that separates us all. But before we get into the video, please make sure you hit that like button, the subscribe button, and leave me a comment down in the comment section if you have any questions or if you just want to say what's up to your boy. Options seem to be the new wave, but I remember a more simple time when options weren't as complicated.
What do you want? What do you want?
It's not that simple.
What do you want? God damn it. What do you want?
I lied. Options have actually always been complicated. Investopedia says options are financial instruments that are derivatives based on the value of their underlying securities, such as a stock. An option contract offers the buyer the ability to buy or sell depending on the type of contract in which they purchased. Okay, but how do you make this money? Call options allow the holder to buy the asset at a stated price within a specific time frame. So I'm buying stuff? Put options allow the holder to sell the asset at a stated price within a specific time frame. Basically, options at the most root level is just like insurance. When you purchase health insurance, you have the right, not the obligation, to actually use it. Also, if you do not exercise your right to use your healthcare, you lose it. And that's why they tell you that you should do all your doctor visits before the end of the year, right? If you don't use it, you lose it. Same thing happens with contracts and options. Your health insurance is just a contract in which you paid and signed up for that allows you the option to receive medical treatment at a lower price than normal if you are covered. The cost in which you pay is called your premium. Bro, tell me how to make the money. Chill, B, chill. We're getting there. Options are contracts that allow you to buy or sell stocks, an ETF, or any other underlying asset at a predetermined price. If you purchase a call option, you expect the asset to go up, as we stated. And if you purchase a put, you expect the stock to go down or the underlying asset. The price you pay for your contract is known as your premium, and the cost of your premium is determined by a few factors. Just like life insurance, if you're high risk, your premiums are going to be higher than someone who is hardly ever sick. Stock premiums work the same way. The more likely you are to be successful by your contract date, the higher your premium for your contract. The price of your options can be determined by a few things in which we like to call the option Greeks. No, not that Greek, but we'll cover the option Greeks in a future video. The best thing about options is that you can secure a lot of shares, but only risk the cost of your contracts or your premium. As we said, just like health insurance, if you do not exercise your rights to use your health insurance, you lose it, or you lose what we call your premium. So if your health insurance is $35 a month and you don't use it one time, then you would have wasted $420 by the end of the year because you did not take advantage of your free healthcare. But a loss of $420 is way better than not having healthcare and then getting into a major accident and having to pay the entire cost of your medical bill without a copay. Normally, each contract you purchase reserves the right, but not the obligation to 100 shares of your underlying asset or your stock for this example. So if you purchase 3 Nike contracts, then you would be able to purchase up to 300 shares of Nike within 100 share intervals. So 100, 200, or 300 at a given date if you decide to exercise your right. That doesn't mean that if Nike's at $100 a share right now and you purchase 3 contracts and you're gonna pay $30,000. That's just not how contracts work. Remember, we're working with premiums here. We'll get into an example and do all the math for you a little later, so hold on, okay? It's important to understand that the seller of the 300 shares of Nike has to hold those shares until you decide to either purchase your shares, discard your contract, or your contract expires worthless. Options are very lucrative, and that means that they can become very risky. High risk, high reward. The more money you can make also means the more money you can lose. So in the back of our minds, we have to remember what a great man once said by the name of Uncle Ben.
Remember, with great power comes great responsibility.
If you can make a lot of money, you can lose a lot of money, and options trade very quickly. So that means that you can lose it fast. If you don't know what you're doing, please stay away from options until you have a better understanding. I highly suggest trading paper money on Thinkorswim platform or any other platform that allows you to do theoretical trades without using your own money, so you can get a better understanding of what would happen if you would make said trade. Remember, there's a chance to make money every day. You don't have to make it right now. cultivate your knowledge and become a better trader. It is also important to note that most people who trade options aren't actually letting their options expire. Most of them are buying and selling option premiums. If you're buying and selling premiums, basically what you're doing is trying to predict the underlying asset's price movement. As the underlying asset moves in the predicted direction, the option contract becomes more valuable to other traders. So just like stocks, you can buy and sell contracts without ever purchasing the underlying assets. This is a little more risky, as I've said, but it does have big paydays. If you can predict the correct movement, it's nothing to make 100% gain within the first few days of your contract, but it's also very likely that you could also lose 50 to 80% of your money as well. So let's look at an example of a call option. We're going to select Nike as our underlying asset. Now let's just say that we expect Nike to reach $130 by November. Currently, Nike is trading at $98 a share. We are going to look for the November calls inside of our option chain that has a good premium that we can afford and some room for error just in case Nike doesn't hit the 130 mark. Let's pick the 105 calls for November 24th, 2020. The current asking price for these contracts are about $3.30, and this price is determined by the option Greeks. We want to buy one contract of Nike just because Nike is a pretty expensive company. One contract ensures that we can purchase 100 shares, so we will multiply the call ask price by 100, and that will be our premium. The call ask price is currently $3.30. Multiplied by 100 gives us $330 as our premium. So we will pay $330 for the option to buy Nike at 105 by November 27th. A few months pass and it's October. Nike hits $135 and we are ready to exercise our option. So we go to our brokerage account and we close out to exercise our option. So the cost of closing your contract will be 100 times 105 plus 330. 100 represents the number of shares that we're going to purchase. 105 is our agreed upon strike price and the price that we will purchase Nike at. 330 is the cost of the contract. Although Nike is at 135, we have the right to buy at 105. This gives us a $20 per share profit, making us $2,000 immediately. Awesome, right? Now, if Nike never passed our break-even point, we could just let our contract expire, or we could sell our contract to someone else and let them take on the risk. But the most we could lose is $330. Puts just work the opposite way. Instead of buying at agreed upon price, you get to sell at that price. So you buy lower, you get to sell at the higher price. If you guys need me to go over a put option, please let me know down in the comments. But I just want to keep the video as short as possible for you guys today. If you like the video, please do me a big favor and help me grow this community by liking and subscribing and commenting down below. It really helps us generate traffic to grow this wonderful platform that we are trying to build. This is Breaking Stereos. This is our community, our platform, our voice. I will see you guys next time. Happy trading.